Most people are watching their portfolio and hoping for the best. That is not a strategy. That is a wish. In the next 5 minutes, we are going to tell you exactly what is working right now, what isn't, and what the smartest money is actually doing in this market. No fluff, no vague advice. Real moves for a real situation. Here is where we are. Inflation is rising again. The Fed is frozen. Rate cuts that were supposed to happen this year are gone. The S&P 500 dropped 5% in 5 consecutive weeks, something that has only happened twice in the last 15 years. And a war 7,000 miles away is repricing almost every asset class simultaneously. This is not a normal market environment. The playbook that worked from 2010 to 2024 is not the playbook for right now. So let's talk about what is. The first thing to understand is what stagflation does to a standard portfolio. Most investors hold a mix of stocks and bonds. The logic is simple. When stocks fall, bonds usually rise and cushion the blow. That relationship works in almost every market environment, except this one. When inflation is the primary threat, stocks and bonds can fall together. Goldman Sachs flagged this directly in March. The traditional 60-40 portfolio is under pressure precisely because the assets that normally offset each other are moving in the same direction. When your hedge stops working, you need different hedges. So what actually works when inflation is running hot and rates are stuck high? Number 1, energy equities. This one is straightforward. Oil above $100 is a headwind for almost every sector in the economy. It is a tailwind for the companies pulling it out of the ground. Energy stocks have outperformed the broader market significantly since February. If you don't have energy exposure in your portfolio right now, you're paying the oil tax without collecting any of the benefit. Number 2, commodities and gold. Gold surged above $5,400 an ounce in March as investors moved toward safety. That is not a coincidence. Gold has historically been one of the most reliable inflation hedges across every major energy shock since the 1970s. Commodities more broadly, including the fertilizers, metals, and materials also disrupted by the Hormuz closure, are seeing price pressure that benefits producers. Number 3, tips. Treasury inflation-protected securities automatically adjust their principal with CPI. When inflation runs above expectations, as it is right now, TIPS outperforms standard treasuries. Morgan Stanley specifically called these out as worth adding in the current environment. They are not exciting. They are not going to make you rich, but they protect purchasing power while everything else is uncertain. Number 4, defense and industrial stocks. Markets have historically posted gains in the defense sector during wartime, including double-digit increases during both Gulf Wars in the months following the onset of conflict. Morgan Stanley recommended increasing exposure to defense, security, aerospace, and industrial resilience specifically for 2026, noting that government spending can drive multi-year demand in those sectors regardless of how the conflict resolves. Number 5, high-dividend defensive stocks. Healthcare, utilities, consumer staples. When both stocks and bonds are under pressure simultaneously, companies with stable cash flows and consistent dividends become the shock absorbers in a portfolio. They are not exciting, but right now boring is a feature, not a bug. Here is what most people get wrong in moments like this. They panic, they sell, and they miss the recovery. Defiant Capital looked at 40 major geopolitical shocks across 85 years of market data. The average S&P 500 loss in month 1 was less than 1%. The average gain in the following 6 months was 3.4%. The investors who got hurt were the ones who exited at the bottom and bought back in at the top. Goldman Sachs's baseline expectation is that markets recover, that we won't have a recession, that inflation won't become fully unanchored, and that 60-40 portfolios stabilize over the medium term. That is not a guarantee. But it is the base case from the people with the most data. The right move right now is not to do nothing, but it is also not to panic. It is to make sure your portfolio is positioned for the environment that actually exists, not the one that existed in January. Energy exposure, gold and commodities, tips, defense and industrials, defensive dividend stocks, 5 moves. All of them grounded in what is actually happening right now. This is not financial advice. These are the strategies the largest financial institutions in the world are publicly recommending for exactly this environment. Do your own research. Talk to an advisor. Understand your own risk tolerance before making any changes. But understand what is happening. Because the market does not wait for you to catch up. This video is for informational and educational purposes only and does not constitute financial or investment advice. All strategies referenced are sourced from publicly available analysis by Goldman Sachs, Morgan Stanley, Charles Schwab, and Defiant Capital as of April 2026. Past performance does not guarantee future results. Always consult a qualified financial advisor before making investment decisions.